Hey guys, welcome back to the channel, best place for long-term stock investors. In this video, I'm going to share with you my thoughts on growth investing. Now specifically, I'm going to delve into number one, what is growth investing? Number two, what's happening to growth investing and why it's doing not so good right now? And number three, last but not least, is will it continue? Now guys, as a disclaimer, I do not own any of the stocks mentioned on the slides. Alright guys, if you didn't know, we have a free masterclass just for you where we train you how you can build a 6 to 7 figure portfolio using the power of stock investing. If that's something you're interested in, you can sign up for the masterclass in the comment section or the description. Alright guys, let's start off by describing what growth investing is. Now, if you're new to investing or maybe you're not aware, typically in the investing world, not the trading world, it is divided into three different broad categories. Now, the first is value investing, second is dividend investing, and then the third one is growth investing. Now, the thing is, each of them are actually quite different, but the focus today, of course, will be growth investing, and we'll also touch a little bit about value investing as well, because the contrast is really what helps educate you. Now, as a general principle, growth investors typically focus in on, guess what? Growth. Now, specifically what? Growth in earnings. And better yet, not just absolute growth in earnings, but relative growth in earnings versus their peers in the same sector. So it's not enough that they're growing fast, but that they should be growing faster than their peers or competitors. Another aspect of growth investors is that because growth is king, they tend to ignore this thing called valuation, something that value investors tend to take very, very seriously. So what exactly is the difference? Let me explain. Now, value investors typically don't want to overpay for things, right? They are typically called cheapskates. Whereas growth investors always say that, hey, look, when you buy a company that is growing really fast, they are a premium stock, right? Like a premium product. So guess what? If you are going to buy something premium, be prepared to pay premium prices. Now, growth investors, in contrast to value investors, also like to focus on companies that have a lot of growth runway, but more specifically, where they're addressing a bigger and newer market. Whereas when you compare it to value investors, they typically operate and look into stocks that are more mature. Now, before I move on, actually, I don't quite agree with this distinction, but I still explain it this way because this is what is typically understood and taught in schools or on the internet. My definition of value is very, very different. And if you stay until the end of the video, I'll explain to you what real value investing actually is. Now, to give you a clearer picture, maybe I'll give you an example. Now, an example of a growth stock would be called Netflix, right? Over the past 5 years, they have an average revenue growth in between 20 and 30%. And if you can see right here, their PE ratio, which is valuation, can range between a high of 144 to 54. Now, if you didn't know, if you're not in the industry, this is typically very premium, right? This is typically what value investors will call overvalued, whereas the growth investor will say, hey, Netflix is a great stock, you better be paying for these prices. Now, in contrast, a good example of a value stock will be Intel Corporation. So the 5-year average growth rate in terms of revenue for them is roughly around 7.5%, and their PE ratio is a lot lower at 9 to 13. Now, alluding to my earlier point, you can see both companies operate in pretty different segments of the economy. One is very fast growing, which is video streaming services. The other one are just chips and a whole lot of other stuff, which is typically an established, mature market. Now, closer to home in Malaysia, we have Vitrox Corporation. So over the past 5 years, their revenue growth can range from 20% to 50%, can be quite volatile, but they are generally in the double-digit range, and sometimes, like I said, close to 50%. That's crazy amount of growth, definitely a growth company. And typically, the PE ratio is 40 to 50 times earnings. Again, typically considered high for value investors, and at the height, it is 66 times earnings. Now, an example of a value stock in Malaysia, and sometimes this can be actually a dividend stock, is Maybank. So Maybank is a bank, right? 5-year average revenue growth rate is 5%. It's the biggest bank in Malaysia. And then the PE can range between 10 to 15 times. A lot smaller than Vitrox. Now, why is that the case? Well, Maybank, as big as it is in a stagnant market, right? Most Malaysians already have banks and loans and things like that. There's no new areas for growth, whereas Vitrox is in the tech manufacturing sector, and there's a lot of room for growth in that industry. Alright guys, if you're interested in working with us on a private one-on-one basis to improve your stock investing skills, we have the perfect solution for you. That is our Mentorship Program. You can actually apply it in the comment section or the description. Now, key thing is that not every one of you will hop into an interview. Only 20% of you ever get to be interviewed by us. And even if you actually hop on the program, it's an exclusive program. But if you're interested and if you're confident that you can qualify for it, go ahead and apply. Okay, enough about the definition and description of growth investing. Now let's look at how growth stocks have been doing, at least in the past year or so. Now, the index that is best representative of growth stock is this thing called the Nasdaq Composite Index. A lot of the tech stocks like Apple, Microsoft, Amazon and all that are in there, so it's a pretty good representative. And as you can see in front of you, it is down nearly 28% year to date. Very, very painful. Now, looking deeper into the Nasdaq Composite, I've just picked out two what the market typically call growth stocks. Will be Netflix, as I mentioned earlier on. That company is down 59, nearly 60% year to date. And Nvidia, the guy that does, graphic cards, chips for your PC, is down 56%. So it has been really, really painful for growth investing, and a lot of people are saying that it is dead, right, because of this. Now, closer to home in Malaysia, we have the Bursa Tech Index. Now, that index is down, as you can see, 36% year to date, following the Nasdaq in terms of trends. Now, specifically deeper into the Bursa Tech Index, we have Vitrox, down not so bad actually, but still down quite painful, 22.8%. And then JF Tech, which is another somewhat tech company, is down 52%. So not only in the US, it's painful, in Malaysia, it is painful as well. Okay, just to highlight how difficult it has been for growth investors, we look at the comparison between Warren Buffett and Cathie Wood, or Berkshire Hathaway versus ARK Invest. Now, leading up to 2021, many people were saying that value investing is dead because Cathie Wood or ARK Invest did so well, especially when compared to Warren Buffett, the legendary investor, and people were saying value investing is dead. But when you look at the 1-year number, ARK is down nearly 2/3, 64%, whereas Warren Buffett is flat. In a bear market, in a down market, that's actually a pretty good performance. Now, before I move on, I just want to add a very, very simple lesson, and that is to a lot of my fellow Malaysians. I still remember last year in 2021, at the end, everyone was saying that the ringgit is going to be bad. Growth investing in the US is going to be where the big ka-ching will happen. So a lot of Malaysians actually transferred their funds into US dollars thinking that they were safe. They can prevent the depreciation. But guess what? The assets depreciated even more by 50-60%. Why? Because, of course, growth investing didn't do well. Now, what is the lesson here? The lesson here is that while it's true, the ringgit depreciating is not fun. What is not as fun, what is even worse, is that you do not understand your investments. So that's just a side lesson for you. Now, getting back to the topic of growth investing, you might be wondering why in the world is growth investing not doing very well? The answer is relatively simple. Two things. One, liquidity, and two, interest rates. Sounds like very fancy words, but don't worry, I'll simplify it for you. Now, as you can see in front of here, this is a chart describing the federal funds rates or the interest rates in the US specifically. Now, why this matters is because when the interest rates are low, so this is like from 2009 to 2016, then again in 2020 to 2021, people can actually borrow money very cheaply to fund their growth companies, right? And typically these growth companies are a lot riskier. Then next, when interest rates are low, guess what? Savers will want to look for riskier investments because now their interest rates are so low, might as well go out and look for other investments to make. They don't want their savings to dwindle as well. And so a lot of that money actually goes into area like growth companies and crypto as well. Now, those are just for savers and people who want to borrow money. How about existing investors? So when the interest rates drop, guess what? Now they are looking for, or their threshold for risky investments have lowered, right? So they will be, if they're holding like value stocks or whatnot, they'll be thinking to transition and rotate some of that money into risky investments like growth companies. So in a nutshell, this is why liquidity and interest rates can actually affect positively and even negatively in the reverse when it comes to growth companies. So this is a chart by Goldman Sachs where they compared world, not just US, value versus growth. So you can see it's a bit of a cycle. However, growth investing seems more common. And what we are looking now is that the growth investing outperformance may be waning, and it seems like value is actually going to overtake. Now I'll give my comments and my thoughts in the next segment. Hey guys, enjoying the video? If the answer is yes, remember to like, comment and subscribe. Click on the notification bell so whenever new videos pop, you'll know it fresh. So, is growth investing dead? The short answer is no, but as usual, the answer is a little bit more nuanced and complicated. The fact of the matter is, no matter what era or period of the economy that you're in, people will always prefer, and when I say people, I don't just mean like ordinary investors, but institutional investors as well. They will always prefer growth, right? Especially earnings growth. And as long as that stays true, growth investing as understood commonly will always exist. It will never go away. But in my view, it's actually most important not to be a growth investor, a value investor, or even a dividend investor. The most important thing is to be a business investor. And so when you go into an investment, you are not asking yourself merely what is the earnings, right? If you are planning to buy an entire business, earnings is one component, a big component, an important component, but that's not the only question that you will ask. Another question that is very, very important is how much you should pay for it. And that was the big problem with a lot of growth investors, right? They ignored a very important component in investing is how much you should pay for it. And so they only focus on one aspect. And I get it, right? It's always easier to just focus on one number or one aspect of a company, right? It just simplifies everything. But I would think that actually it oversimplifies. And so if there's one thing you can learn from today is the fact that although growth matters, valuation matters as well. And some would even say valuation matters even more. Now, specific to valuation, a very important term you need to know is the risk-free rate. In this case, it's typically the interest rate. So if you're in the US, that would be the 10-year treasury bills. This is the investment that you would make where it's risk-free, right? Now, when the risk-free rate drops, then your threshold for growth stocks can be a lot lower, as I mentioned earlier in the video. But as we are seeing right now in the current climate, as interest rates are inching up into higher levels, or at least higher than historic standards, and by historic, I mean, the past 10 to 15 years, what you need to focus on now is standards. And what do I mean by that is it's not enough to look at just valuations, and it's also not enough to just look at the growth of earnings, but the quality of earnings as well. During the growth investing era where interest rates was low and liquidity was high, people didn't really need to care whether or not the sustainability of earnings is there or not. They just say, as long as it grows, I'll put my money into it. But I think in this current climate, it's far more important to say, okay, it may be growing at 20% or 15% or whatever percentage, but how sustainable is it? The more sustainable it is, the more accurate your valuations will be, and the more likely you will do well in the stock market. So guys, hope you enjoyed this video. Let me know in the comments, right, if you agree with my assessment or not. Always love to hear opposing or even positive feedback, right? Any sort of feedback is good to us as long as it's relevant. And if you are interested in other videos, you can go watch some of our other videos. Share this video with a fellow growth investor if you know one. And, follow us on our socials, the usual, Telegram, Instagram, whatnot. I will see you in the next video.